Have you ever wondered what the term business cycle refers to? This video teaches you what the business cycle is and why it plays an important role in investing. Also, you will learn how to evaluate the business cycle using indicators, and you are provided with 5 simple indicators to get you started. So what is the business cycle? Economic activity is measured in real GDP, that is gross domestic product adjusted for inflation. The GDP equals the total value of all final goods and services produced within a country in a specific period of time. The term business cycle describes periodical deviations of growth in real GDP from its long-term trend. The economy doesn't grow in a linear fashion. Instead, patterns of economic expansion are followed by patterns of economic contraction, which are also called recessions. Very severe recessions, like the 2008 financial crisis, are called depressions. The graph illustrates these deviations from the long-term growth trend. Expansions end in a peak, followed by recessions, which end in a trough. These 4 major stages of the cycle each have their own characteristics. During expansions, economic output is growing, employment is rising, thus pushing consumption higher. Overall investment is high due to a low perceived risk. When the economy reaches its peak, growth comes to a halt and consumer prices usually have reached a high level. Also, the economic outlook starts to worsen. Now the economy enters a recession where the growth is declining or even negative. Unemployment rises, causing less consumption. Investment is often postponed due to high uncertainty. The recession ends with the economy bottoming out and the first signs of improvements on the horizon. You may ask, why is the business cycle important to investors? Well, investors are concerned about company earnings or more broadly about asset prices. When the economy slows down, company earnings usually decline, having a direct effect on the stock market. Other assets such as real estate and commodities are also affected by less overall demand. It's important to note that some industries suffer more from a recession than others. I'll explain this in more detail in the next video, which will be about business sector analysis. If you want to evaluate the economy, you can use economic indicators to do so. There are 3 categories of indicators. Leading indicators change in advance of the economy, for example the Production Managers' Index or consumer confidence. Coincident indicators describe changes in the economy as they happen. Examples are industrial production or trade sales. Lagging indicators change after the fact, such as unemployment and consumer prices. To gauge the economy, you should therefore focus on leading and coincident indicators and compare the changes over time. There is a huge variety of economic indicators. I will show you 5 easy to understand indicators that you can use to assess the economic outlook. Interest rates function as a leading indicator. When the economy shows signs of weakness, central banks lower interest rates. Rate cuts make borrowing cheaper, thus stimulating consumption. When prices become too high, on the other hand, central banks can increase interest rates to make borrowing more expensive, which has a slowing effect. Another helpful leading indicator is the Consumer Confidence Index. In a survey of 5,000 households, people are asked about their view of the current economy, as well as the economic outlook. If households are positive, you can expect solid or increasing demand from consumers, stimulating the economy. Retail sales complement the Consumer Confidence Index as a coincident indicator. Retail sales reflect the demand for consumer goods, which is the backbone of every economy. A rising number indicates that consumer spending is growing and the demand side of the economy is healthy. The Purchasing Managers' Index, or simply PMI, is another leading indicator. There are several PMIs. The headline PMI surveys purchasing managers about new orders, output, employment, suppliers' delivery times, and stocks of purchases. A PMI greater than 50 indicates economic expansion, while a PMI smaller than 50 stands for economic contraction. Finally, the GDP is probably the most important coincident indicator. It's usually released on a monthly or quarterly basis and measures the growth of the economy as a whole. As today the service industry takes up a much larger part of the economy, GDP is a better indicator as industrial production. To summarize, the business cycle refers to sustained periods of economic expansion and contraction. As it affects asset prices, investors should follow economic developments. Understanding the business cycle is an important part in a top-down approach to fundamental investing. For further insight, check out tradingeconomics.com. There's a link included in the description of this video. This is a great site that provides free economic indicators for a vast range of countries. If you enjoyed this video, please subscribe and leave a like. See you next time.